All right, let's just jump right into it. If you've even glanced at a crypto chart lately, you've probably been asking yourself one thing. Why is everything dropping so hard, so fast? Well, in this explainer, we're going to get past the panic and the headlines and look at the real technical reasons this is all happening. Let's get into it.
Look, if you've been around the block in crypto for any length of time, you know that this kind of crazy volatility is just part of the deal. These huge drops, they're almost a feature, not a bug. But just shrugging and saying, that's crypto for you, kind of misses the point, right? There are some really powerful forces at work under the surface, and that's what we're going to unpack. So let's cut through all the noise, all the headlines screaming, the sky is falling. The truth is, most of what you're seeing isn't just random fear. It's more like a predictable chain reaction. And it's driven by three main things: what's happening in the global economy, how the big institutions are behaving, and this incredibly powerful internal mechanism called a liquidation cascade. Okay, let's kick things off with the biggest reason. And, funnily enough, it has almost nothing to do with crypto itself, and everything to do with the wider world. See, crypto isn't some isolated digital island anymore. No way. It is deeply connected to the global financial system. And yeah, this quote just absolutely nails it. Think of crypto as the ultimate risk-on asset. That means when the big traditional markets get a little nervous and start to sneeze, crypto gets really, really sick. It's often the first thing to get hit, and it gets hit the hardest. And it all really boils down to what central banks, like the US Fed, are doing. When they keep interest rates high, it makes money expensive to borrow. That creates this risk-off mood, where big investors pull their cash out of volatile things like crypto and park it in safer places, like government bonds. On top of that, when the US dollar gets stronger, it just takes more of it to buy one Bitcoin, which also pushes the price down. All right, on to reason number 2. And this one's a bit ironic because the very tools that pumped billions of dollars into crypto this year, well, they're now acting as a super fast exit ramp for all that money to leave. And yeah, you guessed it, I'm talking about the ETFs.
The spot Bitcoin ETFs, they were a total game changer, right? They made it super easy for huge hedge funds and other big money players to jump in. But here's the catch. That's a two-way street. The same plumbing that lets money flow in so easily also lets it flow out just as fast. When those institutions decide to sell, they cash in their ETF shares, and that forces the ETF company to sell actual, real Bitcoin on the market.
And that is why you see those terrifying vertical red lines on the charts. All it takes is a few big players deciding to head for the exit at the same time, and suddenly you have tens of thousands of Bitcoin getting dumped at once. The market just can't absorb that much selling pressure. It creates what's called a liquidity shock, and the price just tanks.
Okay, so now we get to the third reason. And honestly, this is the one that really pours gasoline on the fire. It's an internal crypto market mechanism that can turn a little dip into an absolute bloodbath. We're talking about the liquidation cascade.
It all starts with this one word: leverage. Simply put, it's trading with borrowed money. It allows traders to make massive bets they couldn't otherwise afford. It means your wins can be huge, life-changing, but your losses, they can be absolutely catastrophic.
So let me just walk you through how this domino effect works. It all starts with that first price drop, maybe from those ETF guys we just talked about. Well, that dip causes traders who use leverage to start losing money. If their position falls below a certain point, the exchange's computer system automatically steps in and force sells their assets to pay back the loan.
And that forced sale, that's what a liquidation is. And you gotta understand, the trader has no say in this. It's not a choice. It is an automated programmed event. This forced selling pushes the price down even more, which, you guessed it, triggers the next wave of liquidations for other traders. It just becomes this vicious downward spiral.
And this right here, this explains why you see such insane drops in the smaller coins, the so-called altcoins. While Bitcoin might take a 25% hit, an altcoin can just get wiped out, dropping 80% or even more. They just don't have enough buyers lined up. There's not enough liquidity, as they say, to soak up that flood of forced selling.
Okay, so we've covered the three big technical drivers behind the crash. Now let's pull the camera back a bit. What is all this chaos and painful volatility really telling us about crypto's place in the world?
This is a really interesting way to think about it, isn't it? Because crypto is just so sensitive to how investors are feeling about risk, its price action can almost be an early warning signal, a canary in the coal mine for what might be about to happen in the broader markets, especially with tech stocks. And this slide, Man, this gets right to the heart of the big identity crisis in crypto today. The dream, the long-term story, is that it's supposed to be digital gold, a safe place to park your money when inflation is high. But its day-to-day behavior? It acts just like a super jumpy, high-growth tech stock, moving up and down with things like the NASDAQ.
So the bottom line, the main takeaway here, is pretty clear. No matter what the long-term vision is, for right now, today, crypto's price is fundamentally changed to the availability of easy money in the global system. When that money dries up, so does crypto's momentum. Period.
So, after all that, what should we really take away? Well, first, the market's real weakness is still its lack of depth, its liquidity. A few big whales can still make massive waves. Second, it's so important to separate the technology from the token price. People are still building incredible things in this space, no matter what the price charts say. And finally, as painful as they are, these corrections actually serve a purpose. They're like a forest fire that clears out all the dead wood, all the reckless gambling and hype, and makes way for healthier growth.
And I'll leave you with this last idea to chew on. Anybody and any project can look like a genius when prices are only going up. But the bear market? That's when you find out who's for real. It's when the truly resilient projects and the truly committed investors prove themselves. It's a test of conviction, of technology, and ultimately, of trust. Thanks for tuning in.